Well, clearly the Brexit creates uncertainty that none of us really needed. We're just making enormous progress on climate change. We have the Paris Agreement. Investors are feeling much more confident about investing in renewable energy. So the Brexit doesn't help. It causes uncertainty. We need to be honest about that. The markets have already reflected that. That said, I think that we've heard that the commitment to climate change hasn't changed at all. The public believe it needs to happen. The governments believe it needs to happen. Here in the UK, we still have a cross-party consensus. We have the Climate Change Act. We're expecting the government to decide on the new carbon budget this week, with our existing government. So the train of progress is not going to change. The short-term uncertainty, of course, does mean investors are a little bit cautious, but there are huge opportunities. We see solar energy costs absolutely plummeting, and investors paying enormous attention to those trends. And I think in the short term, yes, in the UK, possibly in Europe, people are not going to invest in big renewable projects until things become a little bit clearer, but there's a whole world out there of opportunities.
I mean, you run CDP, which focuses on encouraging companies to disclose a variety of, I guess, indicators related to their greenhouse gas emissions. Are you sensing much progress on that this year? There's a sort of disclosure task force, isn't there, being run by the G20, among others, and the Financial Stability Board. What progress on that are you hoping to see this year?
Well, so we've seen enormous progress. As you say, in the last 15 years, we've seen a 20-fold increase in companies disclosing their greenhouse gas emissions and climate change information. So 5,500 of the world's largest companies, 60% of global market cap is already disclosing on climate change. Mark Carney's Financial Stability Board task force on climate-related financial disclosures allows us to really take that to the next level, absolutely to mainstream climate disclosure. They're going to make their recommendations to the G20. They're voluntary recommendations, but we really would encourage some of the G20 governments to consider mandating the task force recommendations in time. So the glass is more than half full on climate disclosure already, and the task force really will allow us to fill it.
And in terms of disclosure, we've seen this year some of the major oil companies have said, yeah, we are willing to acknowledge our climate risks a bit more. So BP and Shell have sort of slightly inched that way. In sort of stark contrast, some of the US companies, Exxon, Chevron, have said they're really not very keen on much more disclosure. What kind of message do you think that sends out from companies when they're unwilling to be transparent?
I think it sends a message of caution to their investors. That years ago, an investor said to me, companies that are not willing to disclose are not willing to reveal their risks, and are they really managing that very well? So, as you say, the groundswell of investor interest, to the mainstream investment institutions engaging with these companies, the oil and gas, metals and mining companies, through Aiming for A and other shareholder resolutions, has just gone through the roof since the Paris Agreement. Some companies are still holding out. We know there's going to be winners and losers from climate change. In the oil and gas sector, I think what we can now really start to see, some oil and gas companies saying, okay, we know we need to transition to an energy company. The CEO of Total, Patrick Piane, on my panel yesterday, said, yes, we are going to become more of an energy company than oil and gas. I asked him, when is oil going to no longer be in your portfolio? Difficult question for him, but he said, look, it's going to go down, probably by about 2050. There won't really be any left, and for power it will go quickly, and mobility it will be there for a little bit longer. So it's a tough question. He can't really answer the date, but certainly by 2050 I think it will be gone.
I mean, there's been a lot of talk in the past couple of years about the fiduciary duty of investors and fund managers, almost their responsibility to take into account climate risk when they're either investing in portfolios, I guess, or advising people. Are you frustrated at potentially the slow progress on that? Because a lot's been said, and the UN, I remember bringing this up at least 2 years ago now, and it doesn't seem to have been really much action at sort of ground level when it comes to fund managers saying, fine, we're going to take this into account.
I think the investment community over the last 15 years that CDP's worked on this issue started fairly slowly. They said, okay, we're interested. We started CDP because they said we need information so then we can assess risk. Understandable. We have a lot of data now so they can assess risk. But really in the last 24 months, particularly driven by the build-up to Paris, and now the fact we have the Paris Agreement, which increases certainty. You can see the direction of travel, and investors really believe that both the fact that it is accepted as fiduciary duty for investors to be paying attention to climate change, sustainability issues, but I think even more so that investors now realise that this is an economic and financial risk, and there are going to be winners and losers. The companies that are managing it well, have a plan for a 2-degree pathway, and investing in the future of that are likely to be the winners. And it's that economic changes, the difference between the price of coal and the price of solar that we've seen change in the last few years. The investment in the coal industry is absolutely collapsed because coal is not going to be the fuel of the future. The investment industry realised that. So there's been an enormous change, and it's taken some time. They needed some more policy signals and certainty, but I think we're there now, and the mainstream investment community really accepts climate is a significant financial risk, and it's therefore their duty to act on it.
Do you think your work with the CDP has contributed to some of the coal sector's collapse when people look at the inherent risks there are now in investing in it?
I think so. I mean, investors need evidence. So it's all well and good for us to say climate change is important, everyone's got to do something. That's correct, but it's when we have the evidence of particular companies being impacted by regulation, new technology. I talked about coal a moment ago. We see companies mining companies being impacted by water risks. Investors now suing mining companies over loss of financial performance because of water risk. So there's some real tangible examples and evidence of poor management by companies of climate risk that's cost the company, cost the investors, and that's really changed the mindset.
Final question. In terms of, you mentioned water risk, are we going to see companies suffering as a result of their sort of structural weakness when it comes to needing to consume vast quantities of water faster than necessarily might see the impacts of carbon regulations, do you think?
Absolutely. I mean, we began working on water originally because companies said we should do so, because in some regions, some locations where climate change might be the shark, water is the teeth. So, and we've seen, as I say, certain companies, we saw Coca-Cola in India, mining company, the Pascua Lama mine in Chile, Barrick Gold, lose a lot of money because they didn't do a decent water assessment. So, water is an asset to companies if they don't manage it well. In certain regions, it's a very regional issue compared to climate, but if they don't manage it well, then they're going to have costs.